What a year 2025 has been for gold and silver. In this video, we're going to talk about what drove prices of gold and silver and what is the outlook in 2026. To understand what happened to gold and silver, it just boils down to demand and supply. Let's talk about gold first. You might hear about central banks, you might hear about debt, monetary, interest rates, you might hear about all this mumbo jumbo language. But in plain, simple English, here's what happened to gold. There are more buyers than sellers. See, when you have a commodity that has a finite supply and there are more buyers than sellers, the only thing that has to adjust is the price itself. Keep that in mind, that the main driver has been more buyers. Now, the real question is, why are these buyers have been buying gold? First, let's identify who's been buying the most. You and I, as individual retail investors, did not really move the market. Obviously, the market has been moved by large institutional investor, mainly the central banks. Now, the question is, why are central banks investing in gold as much? First, if you don't know who central banks are, think of them like the insiders of the money game. They're the ones that actually set the interest rate policy, and they determine how much money to print. Here in the US, we have the Federal Reserve. In Europe, you have the European Central Bank, Bank of England, so on and so forth. So the role of the central bank is to do two things. Number one, focus on high employment. And number two, price stability. In other words, try to control inflation. How do they do that? They simply do that by A, adjusting the interest rates. They raise the interest rates or they lower the interest rates. The other tool that they have is to actually print money. They influence the money supply. So now that you have a better understanding why central banks are the insiders of the money game, you have to ask yourself, why are they buying gold? Is there a specific objective that they're after? Because let's face it, gold does not pay any dividend or interest. It doesn't provide any yield. So in order for central banks to give up on getting a yield, there has to be a very good reason. And the reason boils down to a simple aspect, which boils down to control, eliminating counterparty risk. See, central bankers have learned a lesson in 2022 when the Russia and Ukraine war broke out. Western countries, mainly the US, placed sanctions on Russia, and they basically seized the Russians' US Treasury bonds investments. Because that occurred, it is a signal that it can very well happen again. So what happened? Central banks basically said, we don't want to have too much concentration on US dollars. What is the best alternative that at the same time improves the quality of our reserves? Because the central banks don't play the short game, they're very proactive with their approach. They're thinking about the next 3, 5, 7, 10 years. They're not reacting to price on a day-to-day movement. What's important to them is to have a well-balanced balance sheet where the quality of the assets and the reserves are high. So this is exactly where gold comes in. Because a few years back in 19, the International Bank of Settlement, think of them, the central banks of central banks, they labeled gold as a tier 1 reserve asset. What does that mean? It simply means that gold is a very high quality asset. And by central banks shifting away from US Treasury bonds or US paper denominated assets into physical gold, what they simply did, they improved the quality of their assets, while at the same time they minimized the risk of the dollar and mainly other countries' counterparty risk. And another thing happened in 2025, the concept of patronizing. What that simply means, a lot of these central banks, for example, in India said to England, I want my gold back. I don't want you to hold my gold. Previously, a lot of European countries had a lot of their metals here in the US. Germany, for example, still has some of its metals stored at the US. They did that strategically because there was a lot of war going on and they wanted to eliminate that type of risk. Anyhow, coming back to the point of the central banks. So these central banks used to buy about 300 tons of gold a year on average. They went up all the way up to about 1,000. Now, what's remarkable is that although central banks voluntarily report how much they buy gold, there was an article in Financial Times that highlighted that China has been buying gold in the tune of more than 10 times what it has been reporting. And don't forget, China has been reporting some of its numbers of how much gold it's been buying. And the reason why they're doing that is obviously to communicate strength in their currency at some point. I'll give you an example about China real quick. They used to have about roughly 1.5 trillion in US Treasury bonds. Gradually in the last few years, they brought that down to around 750 billion. Okay. So the question is, this is no longer a one-time phenomenon. They're strategically minimizing the dependency or the exposure to the US dollar and the currency itself. And in return, if you look at a chart of how much gold they've been buying, you're going to see that US Treasury bonds are dropping and gold is increasing. So now that you have an understanding of why central banks are buying it, if there's one word that I can summarize their insatiable appetite for gold, it would be simply control. Because they understand once they have it in their jurisdiction, they're in control. No one can take it away from them. And the World Gold Council did a survey. More than 50% of the central banks are intending to continue that buying pattern. And by the way, this is not about the BRICS nation. Brazil, Russia, India, China, South Africa, and that coalition. It's far more than that. Poland has been buying gold, and their reserve has been increasing from about 15 to 20%, and they're targeting to do more. And you look at Turkey, you look at Uzbekistan, you look at many, many different countries. They realize that they don't want to have too much dependency on the dollar. Now, guess what? In the last 2 years, these central banks have strategically been buying gold. Do you think that they've made more money by doing so or less? Think about that for a second. They're willingly giving up a 4%, 5% yield. But guess what happens? Look at some of the articles of how gold improved the quality of the Turkey's balance sheet. Same thing with India, same thing with Russia. So the idea of gold is no longer about this old relic concept of the preppers. It's about strategic positioning. And the strategic positioning comes into play when confidence in fiat currencies drop. When does that occur? It simply occurs when there's too much debt in the system. And it's not a US problem only. In the last few years, you've had the national debt go from 22 trillion to about 38 trillion. And according to the budgetary office, the big beautiful bill is going to add another $4 to $5 trillion. So long as we continue to run a deficit, in simple layman terms, we are spending more than whatever we're bringing in. We spend $7 trillion, but we only bring in $5 trillion. So that $2 trillion has to come from somewhere. See, the difference between you and I and the Federal Reserve, the Federal Reserve can create money out of thin air. But if you and I try to do that, we will be placed in a jail. The point that I'm trying to make is this: so long as you continue to create more currency, so long as you run deficits and your debt grows, specifically to a point where you have to borrow to make the interest payment, there's a problem. See, the government reported that in the last year, every second we added 73,000 to the national debt. Let me repeat that again. By the way, as I'm repeating it, you're going to notice that we added another 73,000, another 73,000. And ironically, that 73,000 is above the normal wage, average normal wage of about 63,000. The concept that I want to communicate is here. When the large strategic buyers, the central banks, they look at the picture, they say, well, we see on one hand that the value of the currency is dropping. We see on the other hand that the Fed is looking at monetary policies that is loosening. In other words, minimizing the interest rates and further devaluing the currency. We see from a geopolitical tension that we want to minimize the risk. So the more you start thinking like a central bank, the more you understand the main objective. It's not about making a profit. It's simply about how to strengthen the position of your balance sheet. So why am I bringing all this up about gold? Because the well-informed investors are the ones that are driving the prices. because they're buying. Who's following? Then you have institutional investors, large endowments, large funds that are saying, hold on a second, maybe we need to have some sort of allocation to this. Then you have the retail investors that are joining the party. But unfortunately, retail investors tend to be a little bit late because they're price sensitive. See, if you exclusively look at gold in terms of pricing, that means you don't understand gold. Then you're thinking about gold simply as a tool to trade and make a quick profit. That's not the intention of gold. To better understand gold, there are 5 principles. Number 1, preservation. Preservation against what? Well, preservation against the devaluation of a currency, because gold is a store of value. You cannot print it. It's a finite commodity, and that in itself has given it its intrinsic value. Look, gold has been around for 5,000s of years. You have over hundreds of currencies in modern day in the last 200 years that we've seen all these fiat currencies have been replaced. But gold remains gold. Why? Because it's a borderless asset. It is not dependent on one individual or one country's opinion. So, store of value becomes very important when you start printing more, when you have debt, and you constantly are spending to a point where you have to borrow and you have deficits. That's number 1. Number 2, protection. Protection against what? Well, against hedge against inflation, protection against some economic uncertainties. Anytime you hear the word safe haven asset, that simply means gold is a flight to safety. Why would you fly towards safety? You would fly towards safety whenever there are some problems economically. In the last, let's say, 20 years, let's talk about the different occasions. During Liberation Day, not too long ago in 2025, in April, we saw the stock market took a dump. Gold was stable. As a matter of fact, it increased. During COVID, gold went up all the way up to almost $2,080 in August of 2020. Flight to safety. During the Great Financial Recession, when the markets dropped about 50% top to bottom, we saw gold increase 3 times between October of 2008 till April of 2011. And we've seen this occur in so many different occasions. This is why gold is a safe haven asset, because there is that confidence that at the very least, I have something that I can depend on. Third, let's talk about proper diversification. See, when you're exclusively invested in equities and bonds and mutual funds and annuities, all of that is paper-based. So you have to start to really rethink about the concept of diversification. For you to be properly diversified, you got to have some asset classes that are completely different and not correlated. It's not about small cap, mid cap, large cap. It's not about tech industry, healthcare, finance, or consumer. And it's not about just the fixed income versus equities. Again, you have to consult with your financial advisor. But I can tell you this: if the most strategic investors, when it comes to gold, they prefer the physical, they prefer the ownership as opposed to the exposure, there's a reason why they're doing it that way. So from a proper diversification standpoint, gold plays a crucial role. Fourth, you basically have a layer of privacy. See, all your assets are in a financial system that it's exposed to the grid, it's exposed to the stock market, the exchanges. If you want something that it's outside of the system, that gives you another layer of privacy, then gold does that. Because when you have it outright, you have the flexibility. See, whenever you're going to sell or buy and sell gold, you're not going to have the same restrictions and questionings that you get when you try to pull your money out of the bank. Okay? See, from a privacy perspective, understand this. There's a reason why Wall Street, government, and banks don't want you to own gold. It boils down to you becoming independent. They want you to be dependent to the system. Why is that? Because once you're in their ecosystem, they're in control. Think about it this way. If there is some sort of a bank failure, if there is a bank closure, and you have the gold in your hand, will you be impacted? No, they're not. They don't have the ability to reach to your gold. That's that additional layer of privacy. The other thing, the reason why these institutions don't want you to have gold is because there's not a lot of ways for them to make a profit out of. Think about it. They sold us this American dream of buying a house. which, by the way, owning a real estate is a great idea. There's different types of real estate. But if you really study how the system is in cahoots, you have your property taxes, you have your bank making interest on the loan, you have the insurance companies. So, but when you have gold, you have none of this. You don't have property insurance to worry about when you have gold. You don't have the insurance to worry about unless you store it at a depository. And you don't have to worry about interest making payment on it because you own it. So once you understand the system, why centralized governments don't like you to have gold, although they have it in the background, they do it because they understand the power of it, but they don't want you to have that same power. So once you understand this concept and you start thinking like a central bank, you're not thinking about making money. Sometimes the idea of you is having some sort of a true form of wealth where you're in control. That is a key. As we're moving a lot faster towards some sort of a digitalized world in terms of the information that's being transmitted, in terms of the currencies that both centralized central banks are thinking about from a CBDC standpoint to all the other digital currencies. 10, 15 years ago, if you even uttered the word digital dollar, it was some sort of a conspiracy theory. Right now, we're seeing the blueprint in the works. We see this genius act that it's passed. We see how a couple of years back they did a pilot testing, the inclusion of digital dollar in the system. So it's no longer a matter of if there will be, it may very well be a matter of when. Europe is far ahead. China is far ahead. So if you want to have some sort of a layer of privacy, then this is where physical gold and silver comes into play. Now that you have understanding of the principles of preservation, protection, proper diversification, and privacy, it gives you that peace of mind because by you having gold, you are taking the necessary preventive measures. And here's what I mean by preventive measures. Imagine this for a second. Imagine you are putting on a seatbelt when you start driving your vehicle, either by yourself or even your family members. You don't put the seatbelt to avoid a car accident. You don't put a seatbelt because you think you're going to get in a car accident. You put the seatbelt because, God forbid, if you were to get in some sort of an accident, at least the impact is minimized. Once you understand this concept, then you start taking preventive measures and approach gold completely differently. This is exactly what central banks are doing. Take a page of their playbook. Don't think about the price and think about, oh, hold on a second, gold is at an all-time high. You know how many times I've heard that gold is at an all-time high? People that said that in the year 2000 and did not buy, they missed out. People that said that the same thing when gold hit 3,000, when gold hit 4,000. One thing you need to understand is it's a very simple concept, is that it's not that gold is increasing in price as much. Gold is exposing the weaknesses and the lies of the fiat monetary system because now it requires a lot more dollars to get the same ounce of gold. If you're someone who had bought gold in the year 2000, in the year 2020, and recently, you know that nothing has changed in the coin itself. But what changed? Gold is not like your iPhone where you need to do some sort of a software upgrade or some sort of a hardware changes. It is the same ounce of gold. Is that it requires a lot more currency, not money. And this is a good point for me to distinguish between the two. When you think about currency, you think about the dollar or any other currency because it's you buy and sell goods and services. It's a means of exchange. It has some different denomination. But what currency lacks, especially when it's fiat, where you can print it out of thin air, it lacks the ability to be a store of value. I want you to picture this for a second. If you and I can go back 25 years and you have an option to pick, let's say, gold versus dollars, and pick a dollar amount that you're comfortable with. Let's just say 100,000, 50,000, a million, 500,000, doesn't make a difference. The idea, what I'd like you to picture is you have an equal value at the starting point. Knowing what you know now, fast forward. When you look at a dollar bill, Benjamin is still on it. $100, it still says $100. As a matter of fact, it says Federal Reserve note. And we can go down another rabbit hole and talk about that for a while, because the word note in itself, it's a debt instrument. Okay. So think about it. When you sign your loan agreement, when you sign your mortgage agreement, you can see the word note. So this is my former banker instinct come into play. Well, let's put that aside for a second and let's go back to the main point, which is to distinguish currency with money. Because our currencies are no longer a store of value, if I give you the option to choose between the currency or real money, gold, because you've seen the evidence right now in the last 25 years where gold went from $300 to about $4,300 as of this recording, more than likely you're going to pick gold. But let's just expose the weaknesses further on our currency. If you go to the government's labor website, and there's a calculator there that's called inflation estimator, you can actually go back and put in what happened to our buying power, what happened to your purchasing power. What is the value of $1 million back in the year 2000 versus today? You will notice that it gives you half of it. Now, what does that mean? See, we in general are accustomed to look at our values by looking at paper, right? You look at a paper, you look at your statement, you see a value. See, you're measuring it in terms of currency dollars. You're not measuring it against a constant stick. Coming back to the concept of measuring stick, gold is that constant. When you think about a foot, you know that it's 12 inches. But what's happening to the dollar? It's not staying the same. It's not staying constant. As a matter of fact, over time, it diminishes. It diminishes in terms of buying power. To understand this, you just have to compare back to things you used to buy versus today. Or better yet, look at yourself for a second and say, maybe I used to make this much. Let's just say hypothetically I was making 100,000 and I was able to save about 10,000. But right now, I can barely save. I didn't do any major changes to my lifestyle. This is where your purchasing power is diminishing. The same goods and services are costing more. To go back to the concept real quick, this is what I talk about in terms of currency versus money. Currency is not backed by anything, right now at least. So, and because they diluted, because they print more of it, over time, it lowers its value. And as that occurs, guess what happens? Gold responds to that. How do you think gold responds? Well, because it's a store of value and it doesn't lose its value by this manipulation and printing, it just maintains itself. So it requires you more dollars to get that. Once you understand this concept and you look at what happened in 2025, we had the President Trump effect. November of 2024, when the election cleared, all of a sudden, the first part of 2025, we heard so many different things. Thousands of tons of gold came from Europe into the US because there was this concept of tariff. Then we heard the concept of we are going to audit Fort Knox because we want to see how much gold we have. Then all of a sudden, when the tariffs kicked in, the market jolted and we started seeing some weaknesses within the labor market. Month of October, for instance, we have about 1 million of layoffs. What did that do? Well, we gradually see the unemployment numbers go up. Inflation is also gradually going up. We're roughly below 3%. But everyone knows that 3% is a joke. You know, it feels a lot more than just 3%. As a matter of fact, there is a website called Shadow Statistics. You should visit it, and it tells you that the real inflation, as it used to be calculated back in 1980s, it's roughly at about 8%. And here's another dirty secrets that the government does. They changed the way they calculate inflation so the Social Security benefits are minimized. I think at the beginning of this year, at some point, I got a call from my parents saying, hey, Alex, you'll be surprised. We got a raise. Uncle Sam gave us a raise. I said, but what happened to your insurance premiums? That's where we're actually going back. So anyhow, the point that I wanted to make to you is that inflation, if we take the real inflation of that 8%, and if we use a simple rule of 72, this rule of 72, if you haven't heard about it, the concept is how many years is it going to take for me to double my money based on the interest that I'm making. So what they quote us is that on average, the stock market has provided you about 10% return. So if you take 72 divided by 10, you get about roughly 7.2 years. So the concept is that, hey, stay in the market, ride the wave over a long period of time, you're going to double your money. And I'm talking about the index. I'm not talking about a specific company. So with that being said, if you take that concept of how long is it going to take for me to double my money, let's understand the reverse of that, which is with the 8% inflation, in how many years will I lose half of my money? So if you take 72 and divide that by 8, do some simple math, what you're going to find out is that in 9 years, you're losing your half of your buying power. Who do you think creates inflation? What do you think causes inflation? Do you and I as an individual have the power to influence inflation? Are we in an agreement of how much the Federal Reserve is going to print? Are we in an agreement with how much the government is spending? Because we don't have control over that, we can only deal with the consequences. And what is the consequences? Inflation. It's that hidden tax. It's the way that it is taken away from us. Think about it this way. Why is the government not incentivized to pay down the debt? Why? The system that we have, when you have change of power every 4 to 8 years, there's no incentive to pay it down. If one thing politicians and bankers agree on is that anytime there's a small problem, bam, let's go out and print. One does it to gain more votes, and the other one does it to gain interest, because money is where control is. Money is where the power is. So once you understand this concept that no matter what happens, and right now we're in good, okay economy. Imagine if the economy goes backwards for a second. What do you think will happen? Well, one can argue and say that they might be preparing for that by lowering interest rates, because the stock market is an all-time high record, right? If you think about it from that perspective, you don't really need to lower the interest rates. But maybe there's a hidden problem that's lurking. Maybe we're just at the tip of the iceberg and then the problems are getting bigger and bigger. Maybe this AI revolution is allowing companies to use that as an excuse to start trimming the fat so that way they can improve their bottom line and report good numbers to Wall Street. So when consumer confidence drops, when consumer is making less in wages, the consumer spends less. Keep in mind, 70% of the US economy is based on consumption, based on spending. So when that drops, it will could impact the values in stocks. So coming back to the point that I wanted to make earlier, which is all about gold. Gold is simply responding to this monetary cracks that we have. It's not, the math does not work. The math does not work where the deficit goes to interest. Of the $2 trillion in deficits that we have, $1 trillion goes to interest. Essentially, we are borrowing to pay interest. If you had that problem with your credit card company, what happens? There comes a point where they cut the limit. The government has endless amount. And that's one of the reasons why what gives me the confidence about gold is that this problem, spending, deficit, debt, printing, these 4 things are not going anywhere. If you know with a high degree of certainty that this is going to remain, then it'll be very wise for you to have form of wealth that kind of shields you from all this. Whether you are in agreement, whether you like it or you don't, that is irrelevant. But you are going to deal with the impact of that. And the only way for you to benefit at the very least is to have some assets. So don't just be sitting in cash thinking that I'm seeing a number on a statement, and stop valuing your wealth based on just paper currency. Start thinking in terms of real currency. Start thinking in terms of like a central bank. How can I minimize my risk? How can I avoid the worst case scenario? In summary, what has propelled gold is the fact that you have more buyers than sellers. Buyers are motivated by resolving their financial problems. Some don't like the direction of the dollar. Some don't like that the interest rates are going to drop. Because the more they drop the interest rates, the better gold appears. Because the opportunity cost in investing in gold becomes less. To understand this concept, let me give you a simple example. If your bank is paying you 10%, you'll think about it. But when the bank is paying you, let's say 4%, inflation is 3, and then they're going to cut it down to 3.5 or 3.75, you look at it, you say, hold on a second. I'm making less than 1% after inflation. And this is the government's inflation. We're not even talking about real inflation, okay, for a second. This is the government reported inflation. So what investors are waking up to is that they understand it's not about trying to time the market. It's about the time in the market when it comes to gold. Because the idea of gold is not to trade it in a short term. So with that in mind, where you have an environment that the debt is going to increase, we're still having a deficit, and we have an environment where interest rates are going to drop, that propels the demand for gold, not only from central banks' perspective or large institutional investors, but also retail investors. With that in mind, ask yourself, what is the financial problem that I'm trying to solve? What's my time horizon? And once you kind of determine those, then start getting educated about gold. Because if you don't, the government doesn't want you to know about it. Wall Street surely is not going to come to you and tell you, hey, you need to get gold. And your bank is happy you keeping the money with them. So why gold? Freedom, control, wealth, independence, ability for you to have something that you can depend on. Because in the worst day of the market, in the worst day of the value of the dollar, in a day where there are some issues with the bank, the sole financial responsibility rests on your own shoulder. The more you learn about gold, the more you learn about history, the more you understand the benefits and how to strategically position, the more you start anticipating. You won't be surprised when the government says that we're going to sign another bill, and you look at the acronym, and every acronym that the government has, it makes you feel good, right? It's labeled or marketed as such that is for our benefit. But the more you look into it, you realize that the debt is going to increase, and that's going to take away your purchasing power. So if you want a way to kind of avoid feeling uneasy about the dollar, and if you want to have some sort of an independence, gold does that. If you've gotten some value out of this video, give us a thumbs up, share, and let us know what you think in the comments, and tell us about what topics you'd like us to cover. So 2025, it's been a great year for gold. 2026, we're going to cover it in the next video.